Welcome, everyone. My name is Eric Mitchell, founder of Clearview Credit LLC, and today is our first module in credit repair. The first thing we're going to talk about in this journey is basically an introduction to credit. Now, what is credit? Credit is trust in our ability and intent to pay for goods and services received in advance of payment. All this data is tracked using credit reporting systems, and companies use these systems to determine whether or not to give us credit or a loan and how much interest to charge us for it. Our credit is based on bills we've paid, missed, or have been late paying. It's also based on our current amount of debt. Now, why is credit important? Well, it's our financial reputation. And when we mess it up, it takes a long time to rebuild it. You see, most people don't have cash to pay for every purchase, so it's nice to have credit in case you need to. It's also a direct reflection of how much risk we are and also determines how much interest we'll pay. In addition to credit card companies and banks, other agencies and entities can pull our credit. Home, auto, and life insurance companies, employers, utility providers, landlords, and government agencies are an example. Now, who are the three big players in this arena? We call them the three big bureaus: Equifax, Experian, and TransUnion. Equifax was founded in 1899 and is the oldest of the three agencies. They gather and maintain information for over 400 million credit holders. They're based in Atlanta, Georgia, with 7,000 employees in 14 countries. Experian is the largest of the three, based in Ireland, and employs 17,000 people. TransUnion is based in Chicago, provides services worldwide to approximately 45,000 businesses and 500 million consumers. So you can see credit reporting in and of itself is a big industry. Now, what's the anatomy of a credit report? It's divided into these sections here: your personal information, which include your name, date of birth, social security number, addresses, and employment history. We also call this identifying information. Negative accounts is another section, and it's basically anything that's ever been unpaid or late. Positive accounts are things that are been paid on time. Public records include judgments, liens, bankruptcies, and child support. And inquiries are a record of any time our credit is requested. Consumer statements are another section which allow you to explain something on our credit report. I don't recommend that, and I'll explain why in another session. Lastly, furnisher contact information. This is the contact information of the companies reporting our information to the three bureaus. This includes credit card companies, banks, etc. Now, where does this information come from? It comes from the furnisher. These are banks and credit card companies that report our history to the credit bureau, being TransUnion, Equifax, and Experian. The credit bureau then organizes the data into a report and then generates a credit score ranging from 350 to 850. Now, what are some negative items that can show up on your credit report? High balances, late payments, charge-offs, repossessions, bankruptcies, judgments and liens, inquiries, foreclosures, duplicates, and debt. Now, high balances are one of the most important factors in our credit score, and it's measured by our credit utilization. High credit card balances increase our credit utilization rate and decreases our overall credit score. Keep this in mind. 30% of our score comes from our credit utilization rate. So a best practice is to use less than 30% of your available credit. Late payments. This is a big one right here. 35% of our credit score is our payment history. So being late hurts our score. Charge-offs. Statistically, the longer we go without paying a bill, the more likely it will never get paid. After 3 to 4 months of not paying an account, creditors will report the debt as uncollectible to the credit bureaus and government. This allows the creditor to stop paying taxes on the debt as an asset. This doesn't mean we don't owe it. It just means the creditor believes that it is uncollectible. The creditor will then sell the debt or lease it to a third party. Repossessions. When we stop paying for a car, boat, or other piece of property, the bank will sell the item at an auction for a fraction of what is owed, and then we are left with the balance. Bankruptcies. A bankruptcy is a legal status of a person that cannot repay its debts. Most bankruptcy is voluntary by the creditor and can devastate our credit. Judgments and liens. This happens when a judge or government orders us to pay a debt and place a lien. Not a good sign to lenders. Inquiries. This happens when we apply for credit. And too many hard inquiries will lower our scores and make us appear credit hungry to creditors. Duplicates. This is when the same item appears more than once and can make it seem like we owe more than what we really do. Common duplicates are medical bills, student loans, and utility bills that have been to multiple collection agencies. Debt. Quite simply, the more debt we have, the riskier we appear to lenders. Now let's talk about positive items for a moment. This includes accurate information. Our name not being listed properly may give lenders the impression that we are not who we say we are. An incorrect job listing can conflict with what we put on our job application. Low balances, on time payments, aged accounts, the older the better, and diversity of debt are important. Diversity includes having a mix of installment debt and revolving debt. Now, how are our scores calculated? When I realized this formula, it became very easy for me to start rebuilding my credit. 35% is payment history, 30% is debt, including a combination of revolving, installment, and open debt. 15% is the length of our credit history, 10% is how diverse our credit is, and another 10% are inquiries. Now, with payment history, obviously late or missed payments hurt our scores. The newer the item, the more impact it has on our scores. Debt. This includes how much debt we have and which type of debt. There are 3 types of debt to consider. The 2 main are revolving debt, like credit cards, installment debt, like loans for a period of time. Another one is open. Now let's talk about revolving debt a little bit more. This includes credit cards, retail cards, gas cards. And essentially, if we use it, then pay it, it can be used again, thus the term revolving. The most important measurement from this category is the revolving utilization. The higher the percentage, the more it will lower our scores. In general, keep revolving debt usage below 30% or lower if you can. So, for example, if you have a credit card with a limit of $1,000, use no more than $300 and pay it off every month. To really get a boost to your credit score, keep the credit utilization well below 15%. Installment debt. This is a fixed payment or a fixed amount of time, typically seen with car loans or mortgages. Installment debt is not as important and holds far less weight than revolving debt. Installment debt is secured by an asset like a car, home, boat, or motorcycle. And most people will make great effort to keep their belongings from being repossessed. Open debt is less common and it must be paid in full every month. The American Express Platinum and Gold cards are examples. Our length of credit history accounts for 15% of our score. The older the credit, the more we are considered to be stable. The average age is calculated by open and closed accounts. Credit diversity accounts for 10%. Having experience with multiple credit types that shows our ability to handle various account types. So having a mix of credit cards, revolving debt, installment loans gives creditors a snapshot that we can handle various account types. Hard inquiries account for 10%. Now, when you pull your own credit, it is considered a soft inquiry and does not hurt your score. Each time your credit is pulled by someone other than you, it is considered a hard inquiry, and hard inquiries lower your score. Multiple hard inquiries in a short period may signal that we're experiencing financial difficulty, and as a result, may be considered a higher risk. Now, how does debt impact our score? Every dollar of debt owed is considered a risk factor. The more debt we owe, the more likely we are not to pay it. Revolving debt hurts more. Why? It can be reused over and over again. Scoring models determine the likelihood of repayment and risk factors. So ideally, again, use less than 30% of revolving debt and pay it off every month. Installment and secured debt hurt less. Now, how can we optimize our credit scores? We only want positive and accurate information on our reports. If we have mistakes, inaccuracies, or outdated information, there are ways to fix that, which we'll review in another section. Right now, I'm going to share some tips to optimize our credit scores. Number one, have a good mix of accounts. One installment loan and 3 revolving credit cards are considered to be a good mix. Now, with the credit cards, keep the balances low. Also, remember, you have to use them to generate a score. Accounts that are idle or show no activity may stop being reported. So buy small items and pay off the card every month. Keep older accounts open. They contribute to the average age of our accounts. And closing an old account can damage our score. Open and maintain new accounts. There are many types of accounts we can be approved for, even with challenge credit. Credit history accounts for 35% of our score. So if we don't have any, we'll need to open new accounts to increase our scores. And keep inquiries low. Apply for credit only to build credit, or if you really need something. So that concludes our first module, Credit Basics. The next module, we'll talk about how to get your credit report, which is the first action item in your credit repair journey. In the meantime, feel free to schedule a free consultation where you'll receive a personalized credit audit, where we'll identify what is helping you, hurting you, and come up with a step-by-step strategy to get you on your way to better credit.